Welcome to Selfwealth Live, Traders Edition here, technical and where we do a lot of sort of education around technical analysis primarily. How are you this week, Jason? How's it going?
Hey, Rog, I'm good. Good to be back on. Talk about some more charts. Have a look at these markets, see what they're doing. Plenty of interesting things going on. Some all-time highs happening. So yeah, it should be an interesting show.
Exactly. So I'm excited for today and learning. So we're going to obviously go through the markets at the start, like you said. They're just bumping up bit by bit, right? So and then we're going to talk around a little bit of a topic around liquidity. All right, this is obviously a bit of a buzzword, I think, that comes around a lot in our world. And sort of try and explain to people what it is and how you manage stocks with low liquidity at this point. So obviously it's a huge topic. So if we can just start to open up a little bit of that around our education piece, it'll be great, right? So and then we'll talk about some stocks as well, some viewer picks and analyze them. So it should be good. Thanks everyone for coming. Welcome everyone. If you haven't already, please hit like and subscribe, and it will always help us out. And any comments you have, feel free to put them in. Jason, did you want to go through the disclaimer, please?
Yes, everything we do today is general commentary only. No personal advice is given. And I'll put up our disclaimer, which we pop up each week. And that just outlines that what I just said. It's general commentary only. All the licensing details are there. I'm not part of Selfwealth. My business is Motion Trader. And so that's a disclaimer at the top, has all my licensing details there. And then below that is Selfwealth. So yeah, there's our general commentary notice.
Thank you very much. It's an important one to know that any sort of stock that we analyze obviously is general in nature. Obviously, always go and seek your own personal advice and do your own research. Obviously, okay, Jace, let's have a look at the markets this week. The Australian market, let's lead with that one. That is, once again, it's just topping in there a little bit, but it just bumped up a little higher.
Yeah, so it's look, some big developments, I guess you could say, over the last couple of sessions in the local market. So we've got both the ASX 200, which we have on this chart, and the All Ordinaries have both hit new all-time highs. And interesting, really, isn't it, when you look back and you think, look, how many people would have thought this was possible just back in October when it looked like markets were breaking down? And then you think back to the October prior to that, where like all the doom and gloom that was going on around that, and that was only what, just over a year ago. You had pretty much every economist saying that a recession was a near certainty, and it just goes to show how hard prediction is. So it's not to be negative about what people were saying and that people got it wrong, because that happens all the time, because prediction about the future is hard. It's just how it is. And we shouldn't be surprised when most predictions or forecasts are wrong. And that then opens the question, like, if most predictions are going to be wrong, how do you invest with that sort of backdrop? And I think the answer to that is you respond to the price action and you manage risk according to the price action that you're seeing. And if you've been responding to the price action, you've probably been buying shares over the last 4 months. So when we got this false breakdown last October, price got back above that breakdown point. Soon after that, we had a move above the moving averages, and we had those momentum signs. We had the price action suggesting that it was a point where it was reasonable to start taking on some risks, start buying some shares. And I think, look, if you've been doing that, I think that's actually been working out okay. Now, just looking at the last bit of price action, I've been thinking over the last couple of months, really, that maybe this market needs to do a bit more backing and filling, because this has been a strong rally off that October low. So I've thought a likely scenario was some chopping beneath this overhead resistance. And that so far that hasn't happened. We're starting to get a breakout to the top side. So maybe that larger pullback isn't going to happen. And if it doesn't, I don't want to be on the sidelines waiting, because the thing we've got to keep in focus here, I think, is that this has been a big sideways range, couple of years of trading sideways. When these big sideways ranges end, they often lead to large sustained moves that can go on for many months. It's not the sort of, when we start getting a breakout, I don't want to be just sitting going, oh, look, I thought it should consolidate, so I'm going to stick with that and not get involved. I think you've got to be aware when these big breakouts happen, they can lead to those big moves. So I've been building my portfolio up over the last 4 months. I've been telling you that over the last few weeks. And I've added a bit more exposure last week. I'm hesitant to chase stocks that have run hard, and there are quite a few stocks that have had hard runs over the last few weeks. I'm less inclined to want to chase them. My preference is looking for stocks where they're breaking out to a new high, maybe after some consolidation. Maybe they're rallying off a moving average. Getting plenty of motion trader signals where stocks are doing that type of thing, as well as stocks which have been running, but they're the ones I'm a little bit more hesitant with. And as I always say, Rog, it's those wide trailing stops that I then use. And if a larger consolidation does develop, and that could still happen, hopefully those wider trailing stops help see off any volatility and keep me with positions which are currently profitable and doing well.
Of course. All right. So Australian is looking good. What about the American market?
Yeah, that's really been leading the way. So just pulling up the S&P 500, and whereas we've just seen in the local market a couple of new all-time highs, and just in the last week, you look at the S&P 500, it's got a series of new all-time highs, which have been playing out over a few weeks now. And it does, at this stage, it looks like there's more to come. Every pullback is being quickly bought, and the momentum remains to the upside. You just look the price action over the last week. We had this market hasn't come back to the 50-day moving average yet. Every time it starts to come back, it does find that underpinning buying, that underpinning demand. Had that rally up last week, and then this shallow consolidation only lasted 4 days before towards the end of last week, kicking up again. So it's just looking at this most recent price action. It does make me think that we just don't want to stand in the way of this trend. It's if you're already in this market, if you're already long, if you're long stocks, then I think the decision's pretty straightforward, and that is let profits run. That's where the money's made, by letting profits run. It does look stretched. It does feel like it should pause, but I've thought that for a while. But the strategy, despite thinking that, has been let it run, and that's been the right thing to do. And I think that continues to be the thing to do. Having said that, I think that at some point this market will move back to the moving averages. So we do need to keep that in mind. It's not a case of seeing us moving up and just keep piling on risk. And I think this is a thing for people who maybe aren't in the market now. Like, what do they do if they've been watching it rise? So they say, look, do I buy it now? And I think that's a much harder question, because every big trend, they do ultimately come back to those moving averages, and this one will be no different. But we just don't know when that will be or from what level. Like, it's possible this market continues to move higher, and then in maybe in a week or a few weeks or a couple of months it peaks, and we do have a multi-month pullback that comes back below 5,000. But we don't know. So from a risk reward perspective, I think it is a bit harder buying the S&P at current levels. But if you've been following the price action, hopefully you've already got a position, and it's then a case of holding that position until the market tells you otherwise.
Yeah, it's going to take some pretty big news to move this market. Actually, everyone's looking very exuberant. Is that the word? I'm not sure. Is it the word?
It is. It's the word that's been used in the past when markets have been rallying for a while. People get excited, and that one of those reasons why I'd be hesitant to chasing stocks at these levels, because we do know that the markets that run for quite a while or have strong upward periods, they do have consolidations. They do pull back to averages. But as I say, we don't know when or from where. So that's why it's like, if you got stuff that's working, I think the play is let it keep working, let it keep running, use those trailing stops. It's harder if you don't have positions and you're going, what should I do now? It's like, well, it does become more difficult. And that's where I think then you're looking at individual stocks, looking for individual breakouts rather than just taking on that index as it stands at the moment.
Yeah, fair enough. Can I ask, Jason, do you trade the US market yourself, or do you use a system for the US markets?
I don't do that much in the individual stocks. I've got my hands full with the local market. There's so many opportunities locally that it just has an extra complexity to then start going through all the US stocks. And but it's look, it's completely doable. There are opportunities, great opportunities there. Often, if I'm going to do US markets, I do it through index ETFs. Or maybe some funds might be sitting with a manager of some description. It's but yeah, it's definitely a market I have exposure to. Not as much on the individual stock level, although I've got no issue with it. It's just like there's only so many. I came to the conclusion years ago there was only so many opportunities I could follow, and there were many I was just going to have to let go. And that's always going to be the case. There's interesting things happening in commodities. There's interesting stuff in the US and other parts of the world. But yeah, you've got to just come to that acceptance that you can't follow everything.
Yeah, opportunity costs, right? So you can only do so much. You're going to have to sacrifice something else, right? So yeah, it's interesting because might tie into our topic around liquidity, because I always have a few clients that will always say, "Oh, I prefer the US markets because there's a lot more liquidity in US markets, right? There's a lot more people trading, there's a lot more movement, a lot more volatility." But then on the opposite side, there's always a lot of clients that will say, "Look, the Australian market is enough, right? There's plenty of opportunities in the Australian market." So.
And that's right. I think there are. Look, everything you said then is valid. But another thing you've got to put in when you're trading the US market, you've got to consider currency risk as well. So you're adding an extra complexity to what you're doing, and that's okay. There's nothing wrong with that. Currency can go in your favour at times. It goes against you at other times. So it's just another factor to be aware of. You're definitely right. There is a greater depth of liquidity in a lot of those US stocks. That can be one of the frustrations with the local market, in that some of the best opportunities are in stocks with less liquidity. But that's what we'll talk about later on. So how can you still potentially take advantage of those opportunities when liquidity is on the lower side? Is it workable? And we'll have a look at that a little bit later.
Yeah, fair enough. All right. There's a couple of questions there, but let's get on to the one that's probably just a bit more relevant to the chart, and we'll get on to Michael soon. Do you want to have a look at this RSI? Is there still that divergence happening there?
I haven't had a look at that for a little while because the trend's been so strong. Sometimes, it's like RSI doesn't look, there's still divergence there, and the thing is, it's been in place for a while. So this is why I say divergence is like a barometer. It tells you there could be a weather change coming, but it doesn't always work out. So yeah, we've got divergence there, and this is something I first flagged. Oh, look, it must have been back in towards maybe mid January. It hasn't played out. So rather than just go on and on about divergence each week, it's like you can see when it's not playing out. You can see when the demand keeps pushing the price up. Sometimes you've got to say, look, I can see there's divergence there, and that might make me hesitant to just keep throwing money in and keep buying. But if things are working, I don't want to be taking profit because I can see divergence, because sometimes divergence just doesn't doesn't play out, or a market can just continue running for quite a while after it. It's at this point, I don't think this is giving us a helpful signal, because the market has run so much further than when the divergence initially started coming on. So it's now a case of being aware of it, in terms of, as I say, not maybe being cautious about throwing new money in, investing new money in, but not being scared out of positions which are working. So I think that's a frustration a lot of people have, and they sell good stocks too early. They get fearful that the market's going to pull back, or their stock's going to pull back, they're going to give back money, and they cash in. And then they look at the stock a month later, 6 months later, whatever it may be, and they go, "Oh, geez, I wish I hadn't done that, because look how much higher it is now." So that's why I say, I think the first, be aware of divergence, but divergence doesn't override the rule of letting profits run. I think that's the first thing we need to do, except in extreme circumstances where something's just become too much of a weighty position maybe in a portfolio, and you've got to trim some back. As a general proposition, I think it's you let profits run and you manage that risk with a trailing stop, not saying, "Look, there's divergence. I've got to sell. I've got to take profit. Got to sell." Because
Let's
you
have a
can
look
be
at
looking on with regret.
What's that? Sorry.
Because often you look back with regret and saying, "I wish I hadn't sold out."
Can we have a look at the AS200 divergence and put it on the weekly? And as Kirby said, it's not showing on the weekly, so it has a bit of a long-term view. Probably got the divergence on the daily. I think we've brought that up a few times, right? So, but not on the weekly.
Look, there is divergence there on the daily, and look, just to say, there's always a couple of possibilities in play. We could also draw a bearish wedge here. Now, I haven't shown this before because it hadn't developed enough. I was just watching it through, the latter half of February. But look, the pattern's definitely there. Now this is just the presence of this price action doesn't mean that it's going to break down, because often I've seen these just accelerate through the upper boundary of the wedge, and the pattern disappears. What we want to watch for, and this is when it gets interesting from a downside perspective, if the market were to stall here, come back a touch, maybe a little bit of a rebound, and then start to work through the lower trend line, then that opens the possibility of maybe the market does come back to the 100-day moving average and do some more work. Maybe that longer consolidation could still play out. But the pattern doesn't activate until you get a break to the downside. At the moment, we don't have that. For all we know, this market, at the moment, the path of least resistance is to the top side. So you continue to give, I think, the benefit of the doubt to stocks rising and letting them run, rather than seeing divergence and potential patterns and going, "Okay, that's a signal to take profit," because it may not play out. It's let profits run, use risk management. If stocks turn down, then we lighten up, but being cautious, as I keep saying, just being cautious about the new money going in. Am I chasing stocks which have run hard, or am I getting in new breakouts? I think they're different situations. Oh, and you also said from a weekly perspective. I forgot to do that. Just jump to a weekly. I don't really see the divergence from this perspective, because the market's rising and the RSI is rising. We can't look at this little blip in the last week. It's just not much going on there. It's on a weekly. It's just harder to. I think it's like here's an example. I was looking for an example where it doesn't work out. Here's one here. So this is why I say be aware, but don't base everything on these patterns. So looking at this, you could have concluded, okay, we have divergence on the weekly. We need to be careful of this market. And it did continue rising. There is a pullback sometime after, then it goes on and makes new highs. Then it does go through a large consolidation, but that's months later. This is we were looking at this in January, and then that peaks in April. So it's several months later. I don't know whether you can say, look, this divergence was the lead up. I tend to think they're unrelated periods. And if this market were to run for another 3 months and you get out based on something you're seeing now, well, you might be upset that you got out, going, well, maybe I should have stayed with a trend and then use risk management later on to get out. So, yeah, nothing is clear cut, but we're always managing uncertainty and we're always managing risk, and we're just looking for possibilities and trying to just navigate our portfolios based on managing out that risk, letting things run, but then cutting things when they're not working.
Yeah. Why is it called a bearish wedge, what you just showed us, Jason?
That's the name they came up with it many years ago. It's you get a bullish wedge and a bearish wedge. So the bullish wedge occurs on the downside. And I can't get a quick example for you, but say it was that sort of price action. It's something like this. This isn't one that doesn't all link up, but if it looks something like that, you say that's a bullish wedge because it often resolves to the upside. And the theory with this is that each push to a new high gets each bullish run gets narrower and narrower or less powerful. So we've got a very powerful move, we've got a strong move, we've got a move which maybe, if it's stored here, is less robust again than what we saw in January, early February. And so the buying power keeps pushing it, but it's less strong. It loses its strength on each thrust higher, and then the supply will come in and ultimately the pattern breaks to the downside. In the case of a bearish wedge, or in the case of a bullish wedge, the opposite's happening. The buying power overwhelms the selling, which starts to lose its strength, and the buying wins and pushes prices higher. So yeah, that's why the name is what it is.
Well, I think that's a good explanation. All right, let's have a look at the HK, the Hang Seng. HK.
Yeah, looking at this, it's the most encouraging this price action has been for a while. It's rallied back to this 100-day moving average. We've got the 100 and the 50-day moving averages. We're getting a tight consolidation over the last week or so. Looks like it's getting ready for another push to the top side. We can also draw in a bit of support, just having a look at this. You can just line up some support through here. So let's just try and sketch something in, something like this. So we're picking up a low, some congestion there through here, and now just below the market. So it does look like we will get, the market will attempt to have a push above this high from a week ago, get above that 100-day moving average. And so it does seem like the momentum is shifting to the upside. Whether it's a sustained and long-lasting shift, I don't know, but there's some encouraging signs there. We can also have a quick look at those Chinese stocks. Same sort of pattern. It's a little bit more advanced in that this is kind of where the Hang Seng looks like at the moment, whereas the Chinese market's already above the 100-day moving average. These moving averages are starting to turn upwards. There's more work to be done yet, but this is the tight consolidation we're in at the moment. So we've had the move up, the tight consolidation. They often resolve to the upside, not always, but often. Interesting also, there's plenty of gloom around China in terms of like the property market there, what's happening in the economy. The stock market's been off the boil for a good couple of years. It's too early to call a major turn, but this is a sort of environment that big turns can occur. So it's well worth keeping an eye on and keeping an open mind about.
I was wondering if that's printing a divergence in the opposite way. These charts. Can we have a look?
Yeah, let's have a look. Yeah, it certainly is. Good chart eye there, Rog. It's so you can see the Chinese market has made a couple of new lows, and the RSI hasn't confirmed that. So that's look, there's definitely a sign that the market could be turning. But I like to wait for the moving averages to cross. You can call on weekly RSI, and look, there's divergence there. But weekly, looking at our divergence on weeklies, they take a long time to play out. It's not really a tactical way to approach a market. And when you look at it on the weekly, we've still got these declining moving averages. So, if you look at enough indicators, you'll get enough conflicting things that you'll end up doing nothing. So I'm happy just to look at the dailies at this point and just see whether we've cycled from below the averages to above. The averages are turning. It's an encouraging sign. Let's see how this develops over the next few weeks.
Okay. All right. Great. Let's before we get on to the next sort of educational topic, let's just answer a few questions here that are maybe just a little bit off topic, but I want to get onto them. But before we do that as well, I want to just do a shout out for gold. Have you seen gold? And it's having it's going up.
Yeah, it is. Gold, something I talk about every week in my strategy session videos. And look at this. It's big level here. I just compressed this chart. This is a US dollar gold price. So I've got these 1, 2, 3, 4 big tests of this overhead resistance at around 2080, and we're getting through it. So this is a point where this is a potential acceleration point for gold. We had this brief attempt to get through it in December. That was in thin trade on a Monday morning in our time zone. It didn't last. The selling came in, pushed price back down. It's been coiling up ever since then. Appeared that it could have been losing its footing just a few weeks ago, but there was the demand was there to support it, hold it in. And now we're getting this strong push to the top side. Going to be a really interesting one to watch. Also, when you look at Aussie gold, new all-time high, and so that's been looking. Aussie gold's been looking great for a while. It's just been trending upwards, slowly but surely. And that US gold price is looking good. Gold miners, well, they're a bit patchy. But I think the action at the moment is in the metal, not so much the miners. Of course, there's individual situations which are doing their own thing, but a lot of these big cap miners are just not. They're out of sync with the gold price. So I think the interest at the moment is in the actual gold price and maybe some of those smaller or mid-tier miners which are doing their own thing.
Fair enough. Very good. All right. Well, let's just get on to this question around what's your thoughts regarding market cap weighted versus equal weighted ETFs? This is a bit of context around that, but maybe you can add to that, Jason.
Yeah, they're they've both got their place. I don't have a preference one way or the other. Sometimes I might think one way, another time I might think another way. It really comes down to price action. So, for example, we've got the S&P 500 on a market cap based, and like we all know the news around the top 7 stocks have really been powering the performance in the S&P 500. So this has been a time where you really want your exposure in the S&P 500. If we look at an equal weight S&P 500 ETF, it's not quite back at all-time highs yet. Whereas let me just flick back to the S&P 500. We're well north of that previous high. So the strength has been in the market cap. But there'll be times where the equal weight does better. So if the big caps run hard and they consolidate and maybe they go through some sort of a pause, you'll get a period where the equal weight does better, where you got those middle ranking and the lower end of the S&P 500 running well relative to the performance of those bigger stocks on an equal weighted basis. So there's a case for both, and you can do the same with the ASX 200. There are equal weighted and there are market cap based. Market cap based have been doing better lately because you got the big miners and the big banks have been doing much of the heavy lifting, whereas the stocks in the second half of the ASX 200 haven't been really as robust in their price action over the last few months. But everything swings around. So I like them. I like them as they're also good for looking for divergence sometimes, where you can see if the equal weight isn't performing and the capitalization weight is, it can be a sign that there's lack of breadth in the market, that the market's being driven by some top performers and the rank and file aren't following suit. That can be a warning sign that it's becoming a narrow rally. So they're good to contrast between also, as well as different trading options or investing options. It's good for contrasting between the strength within the market.
Yeah. All right. Very good. Thank you very much for that. All right. We've got a question here. I mean, why do you, I know we don't offer Bitcoin for whatever reasons the company's chosen not to get involved, right? So, but what are your thoughts? Obviously, that's a booming asset right now, cryptos, well, specifically Bitcoin, Ethereum, one of the big ones. What are your thoughts around that? And isn't it divorced of all fundamentals?
Yeah, maybe it is. It's like, I'm open-minded to it. I don't worry too much about the fundamentals around it. I'll just look at the price action, and this is one of the great things about being able to assess price action by looking at a chart. You don't need to be an expert in the underlying product, whether it be a stock or like a company or a commodity. You don't need to understand the supply-demand dynamics of gold to say, look, something's happening in gold. The price is going up. So the weight of money is pushing that. So I'm happy to go with the weight of money. Same applies to Bitcoin. I haven't bought or traded Bitcoin myself. And the main reason for that is it's been too difficult setting up digital wallets and the like. I've had other things on the go and I haven't got to it. And at times I've been disappointed I hadn't gone to the effort to do that, because I've seen some really good trends in it. There have been good breakouts. It's behaved really well technically on a lot of times where you get consolidations, you get a breakout, completely tradable break. So I think it's wrong to sit back and go, I refuse to trade Bitcoin because the fundamentals, there's no fundamentals to it. It's like, if you can manage risk and it's a regulated market, I've got no problem having a go and going with a trend. It's easier to do so now as well. There's ETFs, US-based ETFs, where you can get Bitcoin exposure with just through your Selfwealth account. So Selfwealth doesn't offer Bitcoin, but you can trade I'm pretty sure you'd be able to buy one of those US-based ETFs, which are now Bitcoin orientated. So it's become more accessible. Maybe this is part of the reason we're seeing a rally now. It's just become simpler for people to buy.
Yeah, I think there's about 11 different ETFs now in America that track some form of cryptocurrency, right? So you can get exposure to it through the Selfwealth platform, obviously, but just not direct exposure to the cryptos. So, but yeah, look, the other thing is around the fundamentals. You kind of think, well, it is a little bit attached to fundamentals, isn't it? Because it's, at the end of the day, that's ETFs are created, and all of a sudden, all this money is starting to get pumped into it. So that's not a technical thing, is it? It's something
that's real, isn't it? There's the Bitcoin chart there.
I'm sure it is affected somehow by fundamentals. So
there's a nice sideways consolidation. We have a breakout above rising moving averages, all the things we talk about. Then we've got a pullback to the moving averages and a rally again. It all works. And like something which is just a fad, a boom and then a bust, would, like, if it was going to be a fad, go back to 2018. That could have been it. Or you can even go back to 2014. So it's done this many times. You can look at these charts; they all look pretty much the same. if this was can we go even further back? Yeah, you go back to 2013, boomed, bust, it's all over, everyone go away, nothing to see here. Look, it goes up again, and then stick with it, it goes up again. Then there's another bust. Again, everyone comes out. A lot of people come out and say, no, it's all over. It was all just a bit of nothing. Goes up again. And, the story continues, another bust, new all-time high. So, there's more to it than just a passing fad that people will tire of, because here we are, 10 years after the first boom bust, and we're hitting new all-time highs. So it's a market which just doesn't seem to be going away anytime soon. And if there are opportunities there, and you have access to an ETF, and you've got some money and you can manage your risk, be open to it.
Yeah, and I think now from memory there is a couple of ETFs that might track it on the ASX as well, right? So just have a look for those. Just type in Bitcoin on the ASX Selfwealth platform, you'll be able to find something there. Michael's just Bito and Bitty, BITO and BITI is a couple there. All right, Jace, let's get on to our educational topic for today. Liquidity. What is it? What's liquidity?
Look, liquidity is essentially, I guess when you bring it all down, liquidity is essentially a measure of how easy or how hard it is to buy or sell shares. So a liquid market is going to have lots of buyers and lots of sellers at surrounding prices. So you log on and look at your market depth, and say a stock's trading $1, there'll be a bid at $1, there'll be an offer at $1, and then all the way up $1, $2, $3, $4, and so on. There'll be offers, and below $1, $1.99, 98, 97, etc. There'll be a whole lot of buyers, and there'll be plenty of volume either side. So that's a liquid market, and you can place an order and you can get filled at your price pretty much instantaneously. So you think about the ASX 50 stocks like BHP and CBA and all those big companies. They're your big liquid stocks. You place an at market order and you're filled where the price currently is. Illiquid is, of course, the opposite. So you look at your market depth for an illiquid stock, there are going to be few buyers, and they're going to be fewer. They're going to be fewer buyers. They're going to be fewer sellers, and the prices are probably going to be further apart, and the volumes will be lower. So there might be a bid at $1, an offer at $1.03, might be 1,000 shares on the offer, 500 on the bid. So you can't come in and just quickly buy $100,000 worth of shares. But maybe even $10,000 worth of shares, you might not be able to quickly come in and clear. And because there may only be a few $1,000s worth of stock available at around the price that you want. So that's the thing with liquidity. So those are liquid stocks. You just might not be able to quickly buy or sell at your price.
Yeah, that's a good explanation. I know this is probably not our viewers, but we often have questions come in all the time as to why I've been partially filled, why my order's been closed, and I have to pay another brokerage fee, and not realizing their order's expired, but they've only been partially filled, thinking that they're going to be filled instantly. And we're often having to constantly explain to people, it's a low liquidity stock. You just didn't have, if you're buying, you didn't have the sellers on one side, or if you're selling, you just didn't have the buyers to soak up your order, right? So, and then your order expired, and then you're going to have to get into the market again to try and get your other part of the order filled, right? So it is a common bit of a pain point for people not understanding this. This is why I really wanted to talk a little bit about it today, right? So
yeah, it's an interesting thing about where you say their order's expired and they've got to pay brokerage again. It's like, I think by default, when you place an order on Selfwealth, it's a one-day expiry. So you place your order and it will expire at the end of the day. So when I'm placing an order, I'll always set my expiry. I just click the calendar to the next month and push it out 4 weeks or so. Could be 3 weeks, 5 weeks. I just go some time in the future, because I know with a lot of the stocks which I operate in, it can sometimes take a few days for an order to get filled. So whether it be buying, be selling, I give it plenty of time, because I don't want the order expiring with a partial fill and having to place it again. Of course, if you do that, if you do give it that more open period to transact, you've just got to be aware that it's in the market. You can't just forget about it completely. If say it's a buy order and then there's a big down day in the market and you don't want to buy them anymore, you've got to remember you've got an active order in there. So if you don't want them anymore, you've got to go back and cancel your order. But more often than not, for me, just having that longer expiry, it helps avoid that situation of getting a partial fill and having to replace an order. But also before you buy a stock, have a look at the market depth. Just don't go, I like the idea of that stock. Put in my volume, put in my price, press buy, because and don't go at market. Just don't click at market. Particularly, don't go at market before you look at market depth, or you can get in all sorts of bother in stocks with less liquidity. Because at market just means, you're going to keep paying until your quantity's filled. And if you've got a stock which has $1,000 on the offer at $1, and 300 shares on the offer at $1.05, and another 1,000 on the offer at $1.07, and you want to buy 10,000 shares, it's going to go clop, 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 and you might end up paying some of your shares away at $1.30. So that's where you've got to use a limit. So you've got to be aware. You shouldn't do anything until you understand the process, understand the expiries, understand at market, understand at limit. And if you're buying BHP, fine. At market, you're probably not going to have an issue. Buying a stock which is ranked 400 in the All Ordinaries, you probably don't want to go at market, because you might be paying more than you expected.
Really bargain for. Yep. And we'll talk more about, like, next week's topic. This is going to lead into next week's topic, which is market depth, right? And being able to read that market depth, which is good that we're talking about this, for sure. So how do you identify low liquidity stocks, Jason? Even if you give us some examples on the charts or whatever. Yeah.
Look, when I get a signal, so I run my scans, my motion trader scans every afternoon, and even if I'm not buying anything myself, even if my portfolios might be full, but I'm always curious with the signals, and I'm sending out the signals to the members each day. So I go through and I have a look at everything, and I can tell just by looking at the chart if something is. I can't. Sometimes Sometimes a stock the price action will look like there's plenty of volume, but there's actually not. But more often than not, I can look at the price chart and go, yeah, that's a low volume stock. I'll show you an example. Jump back over to the charts. And so let's call up. This is a stock which came up. I got a buy order on this just recently. A company called Schaefer Corporation. I've traded this before, and I got a really good gain out of it. I think it was like a big double-digit gain a couple of years ago. But it's a thinly traded stock, and the reason I can tell it's thinly traded is because you can see you get a bar where you've got quite a bit of movement, and then you'll get dots. And the dots are just showing there's possibly no trading at all. No volume's gone through the entire day. So it's dots and dashes everywhere. That's the hallmarks of a stock with low volume. And we can add a volume study on. So that's the first clue, it's low volume. And then I'll jump into Selfwealth. I'll look at the market depth, and that will confirm to me either way whether it's low volume or not. I might also have a look at the volume profile, and you can see this is patchy. There are times where there's plenty of quite a bit of volume goes through. Just zoom in on it a little bit more, maybe. There are days where quite a bit of stock goes through, and there's some movement in the share price, and then there's these other periods where the next day nothing goes through. And this is typical of a lot of those lower liquidity stocks. They're a bit patchy, but that doesn't mean that you're not going to get not going to get trends in them. That just means there's something else you've got to manage. And what we can do, let's just to demonstrate the difference in the price action. Let's compare this to say CBA. So just seeing what a liquid stock's price action looks like. And you can see there's no dots or dashes there. Every bar is like vertical bar. It's you don't have a whole series of dots where there's no volume going through. What we can do, we can actually do an overlay. This will just demonstrate it again, so you know what you're looking at when you call up a price chart. And now let me just convert this price for Schaefer to a bar rather than line. And just go to bar, and yeah, so you can see the difference in the two. So CBA on the top and Schaefer down the bottom. That's what a low liquidity stock looks like, and that's what a liquid stock looks like. And then you go to the market depth, and you can just confirm either way. So yeah, that's how I do my initial identification, and then with that confirmation through looking at the market depth.
Yeah, and and we'll get onto this next week in terms of the market depth. But you'll obviously, as you mentioned before in your explanation around liquidity, you're going to see there's generally sometimes a big spread, and then you've obviously got a big difference between the last traded price and the bid and the offer. So sometimes if you put a market order in, you might get rejected because the actual last price is so far away from the bid and the offer that it'd be too much, too far from the market. So you might get your order rejected. You have to put your order closer to the bid or the offer, whichever one you're going for, obviously. So there'll be a large spread, number one. Number two, there'll be a huge, a lot of different price levels on the bid and the offer, right? So you have big differences between the price levels on both sides of the bid and the offer, right? Just showing these are all indications that the stock is very thinly traded. And you just have to go and have a look at any stock under 1 cent, right? They're always, you can see plenty of low liquidity stocks, any stock under 1 cent, right? So, good examples of them. All right. How do you manage low liquidity stocks, Jason? How do you manage them?
Yeah. So it's interesting. Low liquidity doesn't mean that a stock can't be traded, and it doesn't mean that a stock should be avoided. So everyone's got to do what's right for them, for their situation. But a lot of time people say, oh, look, I just stay away from low liquidity stocks. And that might be fine. Nothing wrong with doing that. But also be open-minded to, like, can I actually manage the risk? And is there a situation where maybe they are worth considering? Because some of the best opportunities can occur in these lower liquidity stocks. So we're not talking about stocks where there's like, one trade every 2 weeks. That's like unworkable. But where you might need to do a little bit of work to get your stocks. Some of these can turn out to be really good, really profitable stocks. And I think one of the big advantages a retail trader has, or a private trader has, is that they're often going to be nimbler than a big fund. So a big fund is going to struggle to trade a lot of these mid cap and smaller cap stocks maybe at the bottom end of the ASX 300 even, or at the lower end of the All Ordinaries, which is top 500. But as a private trader, where we're doing less volume, look, a lot of the time you can get in and out of some of these less liquid stocks and open yourself up to some really good possibilities. So I'll give you an example. So I guess jump back to the charts. And let me get another example. So there's a stock called Lark Distilling. And this is an example from my portfolio from a couple of years ago. it's fallen by the wayside in recent times. It's interesting. So this was a boom stock I made a triple-digit gain in, and you look at that, you go, how do you make a gain in that? It's because I had an exit strategy and I sold out after it peaked and kept away from it. But that's a story for another day. I want to take you over to this period here. So this is like, looks a bit like Schaefer, doesn't it? We've got dots and dashes everywhere. So it's a low volume stock. So this day where I've got this vertical bar, actually I'm going to let me put a volume study on this as well, so we can see the volume. So yeah, we can see there are days where a bit goes through, and there are other days where not much ore goes through. So this is the day I bought, and I looked up my records this morning, and so on the 13th of August 2020, I bought 8,992 shares. So it's about $10,000 worth. And so that was nearly half of the day's volume. So about 20,000 shares went through that day, of which about 9,000 of them were mine. I don't remember the bid and offer situation at the time, but just looking at the price action, it opened on its high and it's closed on its low. I'm thinking based on the way that traded and that I got the whole fill on the one day, I probably placed a bid. I probably placed a bid at $1.08. So it opened at $1.10, closed at $1.06. I probably placed a bid at $1.08, which is where I got filled. And that's often how I'll play these less liquid stocks. I'll actually place an order. So it's not a case of just coming out and buying at market. Often it's a case of looking at the price action and going, okay, I can see if I want to buy all my shares now, I might end up paying $1.15 by the time I get filled. I don't want to do that. Maybe the market was going maybe it was consolidating at the time. Maybe I thought the All Ordinaries might have pulled back a little bit, and I've just placed an order. And so the market's come back and I got filled. And so that's how I've played that. So sometimes the case of placing that order and being patient might take a few days. Other times you might get set on the same day. It's not uncommon for me to have to sit for a week to just absorb the stock as it's come back to the level I want to buy at. And as we were saying before, placing those at market orders, that's where it can really become a bit of a mess. So I don't do that. And I'll show you I'll show you how it can get messy when you do an at market order. I just look back through this price action, and just this day back here, this was a couple of years earlier. So you can see it's look how the shares are just it's dots and dashes, not much is going on. And then on this day here, the 29th of December, the market volume is just coming down because it's like almost New Year, so it's a low volume day anyway. You get this big price range. The 20,000 shares have traded hands so it's averaged out probably about $20,000 worth of shares, and it's opened at 93 cents, gone up to $1.20, closed at $1.05. So open at 93, up to $1.20, close at $1.05. Then over the next few days, it's come back down to where it started. So from that, I'd suggest that someone's come in and probably gone at market. Buy me shares at market. And so it shot up, then it's come back down. So that's why we've got to be really careful with these stocks about how you buy them. That's why I'm setting limits. And so I've successfully got into this stock with a limit order. And at market order can be a bit messy. And I'll show you why I do persist with these stocks and why I'm patient with my entries, because they don't all do this, but when they work, they can work really well. Like, look at this. That's by the time I got out, this arrows, that's where I got out. It was a 296% gain. So, not bad for a stock which a lot of people wouldn't have looked at because it would have said, look, it's too hard. But you can manage your risk, particularly if you're doing many relatively small trades. You're not doing half your portfolio in it, but it might be 1/20th, might be a 20th of your portfolio. It might be a 1/50th of your portfolio. That's probably more like it is for me. So it's relatively small, so you can move in and out, and they can make a difference to your overall performance. Interestingly, by the time I had to sell, so I bought about $10,000 worth of stock. By the time I'm selling $38,000 worth of stock. But what tends to happen as these stocks, these low liquidity stocks, start to get some momentum, look how the volume starts to build up. So there's not much volume on the left-hand side of the chart, but as momentum grows, the dots and dashes disappear and it becomes more like normal price action. And so volume's coming in and following a stock which is growing. And this happens in these stocks which are growing. Liquidity picks up as well. So this is one of the things I'm doing. I'm looking for these stocks amongst larger stocks as well. I'm looking for these emerging stocks which aren't going to appear in many research reports because no one's looking at them. But as they start to do well and people are familiar with it, start to buy it, comes to attention, volume picks up, starts growing, good things can happen. So just coming over to where the day I sold, and also looking at my selling strategy. So share price is coming off. Volume is better than when I bought it, but it's still a smaller stock. So selling into a falling market can still be a bit tricky. So what I've done, this is the day I sold. It was the 28th of January 22. You'll see that I sold on an up day. So the market's been coming off. It's hit my trailing stop a couple of days beforehand, but I haven't sold into the declining market. I haven't just gone and hit the bid, because that same issue about if you sell at market, you can end up with a much lower fill than you want. So I've worked on the basis that we've fallen from above the moving averages to below. In these situations, we often get a rebound towards the moving averages. And even if it's going to continue lower, it'll often be a rebound to the averages. So I've placed an order. To sell on the rebound. I've gotten filled on the rebound. And that's been my way of getting out, trying to avoid selling in a panic. You don't want a disorderly exit from these less liquid stocks. Of course, the risk is that I don't get the rebound until much further. But that's a stock market, isn't it, Rog? There's risk involved, but you got to try and manage it the best you can. And sometimes it'll be a case of like sell a portion if I see a bid there for a decent amount, but then just not keep hitting bids. Sometimes I'm waiting for the rebound and trying to ease out of a position rather than jump and panic out.
Yeah, and as Kirby said, if you put something in a market, you've obviously got to be wary of the slippage that you're going to incur. That's why, Jason, obviously you don't put anything in a market. You're wanting to get a certain price. You put in that limit, so you're limited that price, and you may have to work in the orders as that price, as the price comes back to what you want, right? Rather than putting the whole lot on, you might have to work in the orders in the market, right, as they say.
Well,
so.
I probably would put the whole, because I don't want to pay brokerage 5 times. Like if you're trying to get out of if you're a fund and you're trying to move a large amount of stock, well then they tend to feed the orders in over time. Given I'm using the many relatively small trades approach, I might be trying to clear $15,000 or $20,000 or $25,000 worth of shares. If I've got a good profit, it might be more. But I might put the whole amount on. I'll just go okay, sell, because I can also modify the order once it's placed. So say I've got 10,000 to sell, and there's a bid at a dollar for 5,000. I might just say, okay, sell at a dollar. I'll clear 5,000 worth of shares out, and then I might say, okay, look, I've got half my position away. I might wait for a rebound for the other half, and I might modify my order and move it from $1 up to $1.05, because I've now just de-risked the situation a little bit. So I might, every situation is going to be different, and I'm going to look at the price action, and I'm going to manage it differently. But I generally start by putting the whole amount on, so I don't need to do a whole series of trades. I can do one trade, but I can modify my levels within the trade.
Yeah. Okay. Fantastic. Good Good way to explain that. So let's have a look at a couple of questions here. But while I have a look at, we do have a few questions around the sort of ATR again, but I think we're going to run out of time to explain these things. We might have to revisit these in the next following weeks, because ATR seems to be a common question. So, for instance, which charting package allows to use average trailing stops? I mean, we're using TradingView on here. This is not TradingView is not relevant to Selfwealth. It's an independent charting package which you can use, and you can just type in ATR, average true range, and that is individual to each stock. It just has a setting which you set as a default, but we'll go into that another time, I think, Jason. What about can we have a look at a stock? Now, I haven't, obviously we've got about 10 minutes left, as we normally would go a bit over time here. But what about WHK? I was having a look at that, and I bought this a few years ago, not off technicals, but more off fundamentals. I like the idea of the company, and now they're getting involved in AI security and all sorts of stuff. Let's start with that. And if anyone else has a stock to have a look at, just to answer your question about the MAs, how many days MAs are those trend lines, please? I think moving averages, Jason uses a 50-100. So if that answers your question there.
Yeah. So 5100 EMAs I'm using. Nothing special about them. I think they suit medium-term momentum or trend trading quite well. If I want to be more active, faster pace, get more signals, I could look at a 10 and 20 day. But a moving average is just handy because it just helps you. It's a great filter in that it keeps your attention on stocks which are above the moving averages that you're using, and it helps you just avoid the stocks which are below the moving averages. So yeah, Whitehawk's interesting. I first heard about this stock when it was on its last upward phase during 2020, 21.
I think that's when I roughly bought it, basically. Yep.
And then it came off the boil. It's the classic tale of above, back below the moving averages, rebound to the moving averages, and then starts to fall away. And it's a case of then stay away until the moving averages tell you to come back. So they haven't called us back for a while. Got a brief crossover in February, but for me, there's no signal there because we didn't get a break to a new high. So that's why I have that break to a new high as a secondary confirmation. So there was no re-entry in February, coming back across, and the moving averages are still to the downside, but they are starting to turn upwards. So it's an interesting stock with cycle from below the averages to above. A lot of volumes come through in the last few weeks. So I wouldn't buy it today because I'd be thinking, well, it's had this big move above the moving averages. There's a good chance that it's going to do a bit of work. Moving averages will cross. I'll start to turn higher, and there'll be another opportunity. If it's going to continue upwards, there'll be another opportunity once we get a bit of price action constructed, and the price action will help us. Will give us some levels, hopefully, where we can then use for managing risk. Because at the moment, like if you buy now, where are you going to put your stop loss? It's like, are you going to get in today? You're going to have it. Well, how do you manage that? Like back below the moving averages is 65%. It's a bit tough to do that. Then you say, okay, I give it 25%, but with the volatility that this stock's having, that could easily come back 25% and take you out. So if you weren't already in at a low level, this would be on my watch list of things which are looking interesting. Who's to say it's not going to do this? And it comes straight back down, sits on the averages, and then breaks lower again. I'm not saying that will happen, but you don't know. So it's hard to steam in now when it's so far above the moving averages. But yeah, interesting stock. Let's keep an eye on it.
All right. What about PLS?
Pilbara Mining. Yeah. It's coming from below the averages to above. Averages are starting to turn. This is, for me, it's not a buy just yet, but it's looking like a stock I'd want to keep an eye on. It's interesting that it's like each time it's broken to a new low, it hasn't been able to sustain it for too long. So it does seem that there is interest in buying this stock as it comes back. It's really a big range in a sense. It's been in since late 22, and that's not unusual because you look at the run it's had. So for me, it'd be a case of just see how the price action behaves. Do we get this sideways compression as the moving averages cross and start to move higher? And then maybe from that we say, okay, well then, like I don't know, but quite often we see price action that looks like that as the moving averages come across, start to come up, and then we start to get the break high, and then that could be the buy point. You're buying as we're moving up out of a compression, but maybe that doesn't form. That's just a guess. That's the sort of setup I look for, but doesn't mean this one's going to do that. So we've got to see what this gives us. A preemptive buy now ahead of a pullback, ahead of a consolidation. It's more manageable. This one's like you could, if you really wanted to, you could buy now above the moving averages and have a 15% stop loss on it back below the moving averages. But I'd prefer to, see how the price action develops and then probably buy into some strength.
Okay, fantastic. TLX.
Pharmaceuticals company, this one. Yeah, price action is good. Trend is up. It's like you can see this how we had a consolidation, then a breakout from that period. This period is kind of similar, where we've can't quite draw the line as cleanly, but you can see where we've got the resistance points up the top, like we had the declining resistance points here, and we got the breakout and a good run. So it may be something like that is brewing again, where and this is classic price action, where you get this a series of tops, and pulls back, then it comes back and stalls again at the tops, pulls back, and then it starts getting ready for a breakout. For me, I'd probably, if I was to buy if I had it, I'd be holding it. If I didn't have it, maybe I'd say, look, let's see if it breaks to a new high, and 12.58, for example, breaks to a new high. Maybe I'd establish a position then. I could then have a stop loss just back around the 50-day moving average, and that's probably an asymmetric risk reward play.
Very good. FMG.
Yeah, the iron ores have been coming off a bit with the iron ore price. Fortescue is no different. Well, if I've got it, I'm holding it, because my wide trailing stop would be managing this so far. So this is, how far back have we come back 16%. So I'd be, if I don't have this in my portfolio, but if I did, I'd be holding it with a wide trailing stop, try and see off this pullback, because that has been a nice strong run. And at some point, as we were talking about with the S&P 500 earlier, these strong moves above the moving averages, at some point, everything comes back and retests the moving average, unless the stock's taken over and it goes off the board. If everything keeps trading, at some point, an index or a stock will come back to the 50-day moving average. So we're getting that in Fortescue now. The question will be, will it stabilise and start to resume upward momentum, or will these moving averages cross and then we're consolidating below the averages, which then makes it vulnerable to further falls? So we don't know which way that's going to go at the moment. We'll only know that in hindsight. So for the time being, for me, it's a case of the overall trend remains to the upside. I'm going to give it a wide trailing stop and see how it plays out. But I'm not in a hurry to buy it just at the moment. I don't want to buy it just here. There's it's because we don't it's come back below the moving average. It's not like it's just tracking sideways on the averages. It has dipped below the 100-day. That doesn't mean it's not recoverable, but just the risk probably goes up a notch. If you buy it here, you're just sort of hoping that it holds. I guess you can still manage your risk, but it's just not the way I like to buy shares. Buying shares that are pulling back and have dipped below the moving averages. I think if you do that often enough, you might come out behind overall. So, yeah, for me, it's hold it if I've got it, watch it if I don't.
And finally, FDX.
FDX. So I wonder whether we're looking at FedEx. Must be. I have a guess.
No, sorry, 4DX. My bad. 4DX.
4DX. Yeah, FedEx looks interesting anyway. 4DX. Must be this one. Yeah, that's an interesting looking chart. This is where it listed back in 2020. Interesting how it's had a couple of big pushes to the upside and it's come back on both occasions. Had plenty of volume accompanied those upside runs. So it's I'm guessing it's speculative. I'm guessing it's not making any money, but it's not without prospects. Moving averages are turning higher. I don't know that there's quite enough momentum to get into this one yet, because it could also see it, do that. This could all peter out again. It could all just be part of this sideways chop. So I probably wouldn't be. It's not a signal for me as yet. I'm probably not inclined to jump in. But for someone so to be aware of a stock like this, there has to be someone's aware of it for some reason, and if they like the underlying story behind it, the risk can be managed. Like, risk could be below this recent low. So that's just, you're looking at maybe 25%. So it's sort of the point where you can say, look, the averages are turning higher. It has broken to a new high point, being above that February high. If someone liked it for some reason, from a pure technical play, I wouldn't go for it at the moment. But if there are other reasons to look at it, there is some signs of momentum, and risk can be managed. Otherwise, it's just an interesting stock to maybe keep an eye on, but nothing really concrete to go on yet with the technicals.
All right. Let's just have a look at one American stock that someone mentioned before. Obviously, we can't give a price target, but let's look at NVIDIA. Obviously, this has been one of those big stocks that are dragging the American market up with all the AI hype. It's just up. That's it.
Yeah. Right? It's like you think, like,
where do you get into that?
Like, you could have looked at it. We could have looked at it this period and going, oh, look, it's had a big run. It's stretched. It's got to consolidate, and actually, it did consolidate for a period, and then that's not dissimilar to that price action we're looking at in Telex, where it had the high and it was bouncing around below the resistance point, and then it broke higher. And that's what can happen when you get those consolidations where it keeps butting up against resistance. When it goes, it can go. Look, I don't know where that goes from here. And this is like what we had with Tesla a few years ago. It just kept going and going and going until it didn't, and then it turned and it came down. But I don't know. If I've got this stock, it's a case of, well, you know what I'm going to say. It's let profits run, use a wide trailing stop. And had somebody been following the buy signal this gave back, so the moving averages crossed back in January 23. We've got a 70-day high, set a wide trailing stop. Wide trailing stop would have seen off this consolidation, no problem, and you could still be on it. So the power of letting profits run, because stocks, can run further and rallies can last longer than almost anyone thinks is possible. And this is a case in point. That's why we don't want to cap upside with take profit strategies, because you only need one or two of these to come through your portfolio every few years, and it really can lead to an outperforming portfolio. So be very careful when it comes to take profit strategies. Yeah, sometimes you might want to lighten up because something's gone so far, but resist the temptation to take moderate gains early on, because you really can interfere with the compounding process when you get on board one of these big ones.
Very good, Jason. Thank you very much. I think we've reached an all-time high in terms of a session today. So with 1 minute 15, we're just bumping up slowly. So it must be some good content that we're giving people, which is great. Thanks for the questions, guys, because I think that's the other reason why sometimes we're going longer, which is good, right? It's great to have the interaction from everyone here. We really appreciate it. Next week, we're going to talk a little bit more about in-depth around the market depth. About the market depth. So that should be good. Thanks for your time, Jace.
That's been fun, Rog. Thank you. Thank you for having me on. Viewers, thank you for joining us. It's been good.
Of course. All right. Thanks, everyone. And we will see you next week. Take care.